Okay, so in today's session, we shall discuss about a few of the important valuation metrics. So in the, I would say the limited time span that we have in the next 1 hour or so, or like 45 minutes or so, like we shall be discussing multiple valuation metrics, right? Or a few of the valuation metrics. And this session shall be carried forward subsequently as well, right? So in case if we aren't able to complete all the valuation metrics today, then we shall complete that in the subsequent recordings or subsequent sessions, right? Because ultimately I'll be going slow and I'll be making you understand these things from the very basic to the most advanced. How to analyze and use these valuation metrics in trying to analyze a company to make an informed decision, that is whether to invest into that company or not, and also comment upon the valuations of the company. We have been discussing about various valuation metrics previously. We have talked about how to analyze the annual report of the company in detail. We have talked about how to analyze the financial statements of the companies in detail, be it the profit and loss statement or the income statement, balance sheet statement we discussed, income statement we talked about, cash flow statement we talked about, statement of equities, notes to accounts. We learned about all kinds of financial ratios, right? Starting from the liquidity metrics to capital structure ratios to efficiency ratios to I would say like multiple valuation ratios as well, right? We also talked about and we also discussed practically how to create a financial modeling for companies, right? How to create a financial model, forecasting assumptions, schedules, and different things for all major types of companies. We also discussed how to do the valuation of a loss-making company and a banking company. If not, then go to the website and try to grasp those modules because new modules have been uploaded where I'm discussing how to value a loss-making company, a company having negative cash flows, or a company into losses simply, how to value IPOs, VCs, private equities, how to value a banking firm, because the financial modeling and valuation for the BFSI space, the banking, financial services, insurance companies, NBFCs, brokers, is completely different as what we do for the other companies, right? We also talked about how to value heavy industrial companies like real estate, infrastructure, cement, right? We talked about some separate financial metrics apart from the so-called basic ratios. Like we talked about like some specific ratios for banking sector, some specific ratios for insurance, NBFC, IT, pharma, hospital, right? All these things we try to discuss. We talked about how to value a natural resource company or a mining company. All these things are there on the website. We talked about such things in the classes also. The recordings are there on the website as well, right? A few of the things you will get to know from the online sessions, like which are being uploaded on the social media also. So that is like one of the things, right? So that is one important factor. So coming back to the session for today, the first ratio that we'll try to analyze is, I'll just share my screen with you very simply. I hope the Word document is visible with you. The first ratio that we'll try to understand very thoroughly, you might know these ratios already, you might have heard about these ratios, you might have gone through multiple modules and multiple live lectures as well to understand these ratios. But in the session for today, we'll try to understand these things in a very different manner, right? From the practical world. Because currently we see markets being too volatile. The Nifty is going down, right? The Nifty small cap and mid cap have also gone down by 16 to 20%. That the market has become too volatile. We have been seeing FIS outflows. We have been seeing the US dollar getting strengthened, the 10-year yield rising now like it has fallen, right? But initially, from a near to medium term basis, all these factors have come into place, right? So the first ratio, if you try to talk about, is the PE ratio, right? The PE ratio is called as the price to earnings ratio. Very simple ratio from a formula perspective, but it's important to understand it from a practical perspective. PE ratio, price to earning ratio. If we just talk about the formula for the price to earning ratio, so whenever we are trying to talk about the formula for the price to earning ratio, it says the current price, the current market price of the share in the numerator, and you are dividing it by the EPS, the earnings per share, the current market price, right? The current market price in the numerator, and you are dividing it by the earnings per share. But one thing is, again, earnings per share is again a derived metric. We need to know how to calculate earnings per share. So earnings per share is basically calculated as your profit after tax divided by the outstanding shares. Your profit after tax divided by the outstanding shares, right? So I'll be keeping these sessions very brief, very quick. I won't be extending these valuation sessions for hours and hours just to make you understand these concepts thoroughly. Okay. Now the thing is, the formula says the current market price of the share in the numerator divided by the earnings per share in the denominator. And earnings per share is calculated as the profit after tax in the numerator divided by the outstanding shares in the denominator. So firstly, let's try to understand this EPS. What exactly is the EPS, which stands for earnings per share? So basically, it takes into account the profit after tax for a company and the outstanding shares which are available for buying and selling in the secondary market, right? The profit after tax in the numerator and the outstanding share, which is the available shares for buying and selling in the secondary market. And what is the profit after tax? It's simply the final margin or the profit the company is making, right? Again, we have something called as EBIT, right? Again, we have something called as EBIT, the earnings before interest and tax. It is the operating profit of the firm, right? It is also called as simply the operating profit. So if someone is talking about what is the operating profit of the firm, they're talking about the EBIT, the earnings before interest and tax. So in this metric, this EBIT component, you have not yet subtracted the interest payments and tax payments. The interest payments and tax payments are yet to be subtracted. And when the interest payments and tax payments are subtracted, you get PAT, the profit after tax. So if we look at a company, right, we all talk about the sources of capital for a company or the two sources via which the company raises capital, right? If we talk about the world of corporate finance, if you guys have gone through the corporate finance curriculums or the financial management curriculums per se, maybe like during your BBA elective, BCom elective, BMS, MBA, or CFA curriculum, the thing is corporate finance is taught everywhere. And then we talk about the two sources of finance, like where the company raises money via. One is equity and the other is debt. Either the company comes up with the IPO, where it offloads share in the market. The people tend to purchase those shares, and initially the first money goes to the public, goes to the company. And then those shares are traded on the stock exchanges in the secondary market. Or the second way is via debt. The company can issue debt via debentures or bonds or some other types of fixed income securities, be it investment grade or high yield, depending upon the class of shares or the investment category or the credit rating for that firm. They will issue a fixed income security, right? People will purchase that fixed income security. Once they purchase that fixed income security, the money will go to the company. And in return, the company will promise them on a written agreement that they will pay them a fixed interest rate for N number of years, be it for 10 years, 15 years, as per the requirement. And again, that money might be used for some expansion activities, for some diversification activities, acquisitions, right? For some new things for which the company might want a gestation period, the company will be using that money. And again, that shall be translated to future volumes or revenues or profits and cash flows, right? So two sources of finance for a company, equity or debt. So whenever we talk about EBIT, it is most important for debt holders, the persons, the people who have given debt to the company via issuing of debt or the fixed income securities, bonds or debentures. Because when they see this EBIT number, they see that ultimately the interest component has to be paid out from this EBIT, right? This interest component has to be paid out of this EBIT, right? So they see if their interest obligations, just try to make a note of this point, try to understand these things conceptually. If their interest payment that we have to receive, so for example, if I am a debt holder, I want my interest payment, and my interest payment annually is due of around like 1 crore rupees. So 1 crore rupees, the company has to pay me every year as an interest payment. So I will see that whether the EBIT of a company or the operating profit of a company is more than 1 CR or less than 1 CR. Right now, there can be like multiple debt holders. We can argue about that. But on a cumulative basis, they tend to see, right, if the EBIT of a company is less than my interest commitment or not. If the EBIT of a company is less than the interest obligations, right, the interest has to be paid via 10 crores. For example, the total interest payment the company has to make to all the debt holders is 10 crores, right? And the operating profit of the firm is just 5 crores. In that case, the debt holders would be in anxiety, in trouble, right? They will say, yeah, the company is making a profit of just 5 crores, whereas the interest obligation is 10 crores, correct? And that interest payment we can simply see in the profit and loss statement, that how much interest payment is due. Or simply we can see via the balance sheet in notes to accounts that how much long-term liabilities are due and how much interest payment has to be paid. And we can try to prepare a prepayment schedule or a loan amortization schedule and get to know that how much annual interest payment has to be paid. And even if we do not do that, it's clearly mentioned in the notes to accounts. I've told you previously how to create a loan amortization schedule. That's clear to everybody, right? But simply that interest component you can see in the annual report, right? So if the profit or the operating profit is lesser than, right, the interest payment, the debt holders are not satisfied. And again, not all the debt holders shall be paid in that scenario. Some of them will be paid, but not all. Again, that depends upon the seniority of their claims, the seniority of the debt holders, right? Though we say that the debt holders have the first claim because they have to be paid the fixed interest payment, but within the debt holders, you also have certain classes. The first priority one, the second priority one, secured, senior secured, unsecured, right? So senior secured or super secured people shall be paid first, then secured, then normal one, then unsecured if something is present. So everyone is in a trouble, right? So that is the thing. That is why a debt holder or anybody who has provided, right, debt to a company, he always looks at the EBIT, the earnings before interest and tax, right? So that is something which is very, very crucial. Ideally, if we talk about from a company's perspective, okay. And once the interest payment has been paid off, the debt holders are satisfied. So, for example, if the EBIT of a company or the operating profit of a company is more than the interest commitments, it means the company can easily pay off the interest on debt, right? So, once the interest has been paid, the debt holders are satisfied. And that's the order. First, you pay interest and then you pay tax. And then you pay tax. And after that, you get the profit after tax. And that is why we also say that debt, it gives you the benefit of a tax deductibility of interest. Tax deductibility of interest. It always has a tax shield, a tax advantage. Whenever a company has debt, he has to pay the interest commitments and as a result has to pay lesser amount of tax upon the remaining profit. So that comes out of as the profit after tax, where the interest commitments have been paid and tax commitments have been paid. And whatever is left is available for the equity shareholders. Equity shareholders or the preference shareholders. I would say both the equity shareholders as well as the preference shareholders. Okay, so this PAT is available to both the equity shareholders as well as the preference shareholders. Now, the company might also pay a dividend. There are certain companies who pay dividend regularly. There are certain companies who pay dividend occasionally, but not fixed. It might be a flexible policy, right? Now, if you're paying out dividend out of this PAT, you paid out some dividend to the preferred shareholders because the preferred shareholders are liable to get dividend. If the company declares a dividend, then compulsorily the first preference has to be given to the preference shareholders. That is like they will get that dividend. Then the equity shareholders, as per the company policies or corporate finance dynamics, right? The policy shall be framed and the dividend shall be split between the preferred shareholders as well as the equity shareholders. So when the dividend is paid off, right? First interest, then tax and dividend, and that's the order. Dividend is paid off, right? Some people tend to call it as PAT itself, right? The dividend payoff karo, the tax payoff karo. But when the dividend is paid off in the world of investment banking or corporate finance, we tend to call it as EACS. EACS, earnings available to common shareholders. Earnings available to common shareholders. So whenever the dividend has been paid out, as a student of finance, you should never call it as PAT. You should call it as earnings available to common shareholders, right? So basically, in that way, Our EPS might be a different EPS formula might change, not in terms of concept, but in terms of just the numerator, right? If I just erase all this, okay. So basically, instead of PAT, it's better to take it as EACS. So it's an earnings available to common shareholders divided by the outstanding shares. Okay. So higher the profit of the firm, higher shall be the EPS. Correct. Higher the profit of the firm, higher shall be the EPS. So we can say that EPS is the proxy for the profitability growth of a company. If a company has higher EACS or higher profitability, the EPS of the company will also be higher, right? So EPS is a proxy for the profit of a company, or EPS is a proxy for the profit growth of a company, right? Now, the thing we need to take into account is sometimes on social media platforms and various news channels, when we tend to hear, like for example, on CNBC, on Z Business, NDTV Profit, Bloomberg TV, ET Money, we talk about the earnings growth of a firm. Earnings growth of a firm. Then we tend to talk about EPS, the earnings per share. You might have heard many analysts, many top management of the companies, top portfolio managers or news anchors saying that the earning growth of this company is expected to be in higher single digit. The earning growth of this company is expected to be muted. The earning growth of this company is expected to be lean or flattish or rising. That earning growth is the EPS growth. They're calculating the profit after tax divided by the outstanding share and getting that EPS. Okay, that is one thing. Again, if we talk about EPS, there can be two types of EPS, right? One is the basic EPS, and the second one is the diluted EPS. Two types of EPSs are there. Make a note. ध्यान देना, basic EPS and diluted EPS. Mostly we tend to calculate the basic EPS, right? Which everyone is calculating. Though, for the sake of reporting, we calculate diluted EPS, and also in your financial modeling interviews, where they tend to give you those blank cells and where you have to fill in the data, right? For the ratios, for the metrics, they might give you to calculate both the basic EPS as well as the diluted EPS, right? So basic EPS is this one only. Simple your EACS or the profit after tax, depending upon the company policy, whether it pays the dividend or not, right? Divided by the outstanding shares. Now, if you talk about the basic EPS in the denominator, the outstanding shares that you tend to talk about are the free floating shares. Are the free floating shares. So what are the free floating shares which are available for everyone to be bought and sold in the secondary market? Because there can be some shares like which are locked in by the promoters, right? Because till this point of time, the promoters might not have offloaded their stake entirely. They're locked in shares. You can't trade the promoter shares until and unless the promoters sells off those shares in the secondary market. You can't trade with those shares, right? There needs to be an offer for sale, but the selling of their shares, existing shares, or exiting the market, promoter sales, founder sales, as we tend to call it, right? So those are the locked in shares. But here we just take into account the free floating shares in the secondary market, which are available for buying and selling. In terms of basic EPS, अभी मैंने basic EPS ही समझाया है. I'm not talking about diluted EPS as of now, right? So that is the basic EPS. But if we talk about the diluted EPS, so what exactly is the diluted EPS? In a diluted EPS, the numerator is same. There is no change, not even for 0.1% in the numerator. Exactly copy paste, be it a basic EPS or a diluted EPS. The change is in the denominator. So in the denominator, you take all the shares, be it the free floating shares, the locked in shares, right? And also there can be some other classes, right? Some ESOPs, some restricted shares, right? Some convertible shares. There might be some fixed income instrument which can be converted to shares, right? Some warrants, right? Now, convertibles are something that might be fixed income at this particular point of time, but they can convert to equity after a certain time, after a certain tenure. Once the vesting is done, you have the right to convert it into equity, right? When the market is favorable. And warrants are something which is neither fixed income or equity. It gives you a right to purchase equity in a company, right? It's just a right. It gives you the right to purchase equity in the company. So all those kinds of locked in shares, free floating shares, convertible shares, ESOPs, restricted stocks, right? They become part of the numerator, all kinds of stuff. Now, what is the difference between ESOPs and restricted shares? We have talked in the modules. We have talked in the 6-in-1 curriculum, investment banking curriculum. The difference between the restricted shares, ESOPs, right? We have talked about that. Like one is more of cash, one is more of cash and kind, like one is more of stocks, right? So just go back to modules and try to understand the difference. So all kinds of shares that we tend to see, that is basically all your diluted EPS, basic and diluted. Correct. So if I just erase the stuff, so there's one question here says we actually add the interest payment, right, of the convertible instrument. So whatever interest payment is being we're getting on a fixed income security back while calculating the diluted EPS, right? So see, basically what is happening, you're adding back the interest payment you talk about in the numerator, right? If I'm not wrong, correct? The interest payment you are saying to get added back, right? As a ESCS, right? Because you're taking into account what? You're taking into account the restricted shares as well, right? So basically what is happening, see, like sometimes they tend to add the interest payment to get that diluted, right? Because the numbers that you tend to get on the moneycontrol.com or the annual reports, in most of the cases, they're not adding back the interest payment, right? Ideally, what should happen? See, to maintain consistency, we talk about the principle of valuations. We talk about to maintain consistency, right? If you have an equity multiple in the numerator, then you should have an equity multiple in the denominator also. If you have an enterprise multiple in the numerator, you should also have an enterprise multiple in the denominator also, right? So यहाँ पे whatever interest payment you might be getting upon those convertible instruments, right? Up to that extent, na, it might be difficult for a company to bifurcate that, right? Because the company gives you as a total fixed income, right? Now, in that fixed income, there might be some convertible fixed income securities, which might be converted to equities. So it becomes very difficult to bifurcate between those convertible fixed income, and how many of them are the convertible fixed income and how many of them are the proper fixed income. There have been some instances where mistakenly people have taken the whole interest payment and added back to the EACS, and the number becomes very volatile. It's completely wrong because puri hi interest payment you have added, right? So it tends to be a risky proposition. If some company is giving you a clear bifurcation, if some company is giving you a clear bifurcation that these are my convertible securities and I'm paying this much interest payment on this, and this much are my proper fixed income securities, the non-convertible one. When it is, then I say it might be beneficial to add that component of the convertible fixed income interest, adding back to that EACS to make that equation and ratio consistent. But if that bifurcation is not there, the number might become, I would say, quite manipulative. The number might not be a healthy one, right? So just take the bifurcation always. If that clear set of bifurcation is given by the company, then add back that interest payment up to the extent of that convertible instruments only. But if not, then keep it simply as ESES. Do not make any kind of modifications or the alterations in the numerator. And then I'm telling you from a practical viewpoint, books, corporate valuation books, theory books, MBA books, right? From a formula perspective, they might say you add back, add back, add back, right? But in the actual world, we need to see that do we have that data available with us? If not, then adding that whole interest payment might be wrong. Okay. So that is something if we talk about ESCS. So see, the major use is of a basic EPS ideally, right? Diluted EPS is something we do not discuss about much in the financial markets. Every discussion is being made upon basic EPS, the number of outstanding shares. We're just bothered about the total shares being traded in the secondary market. How many of them are convertible? How many of them are restricted? How many of that are ESOP? That might differ from person to person. A person having some restricted units or ESOP might be worried about those ESOPs and restricted units, that once the vested period is over, he has the option to exercise at a strike price and then convert it to equity, buy that and sell that in the market, right? Locked in shares are considered about the promoters. वो locked in है, वो market में trade नहीं हो रहे हैं, right? But ultimately we're bothered about the tradable securities in the market, because ultimately all the value that the company shall generate, right, shall be more towards oriented towards the tradable securities in the market, the buying and selling of the shares, the buying and selling of the liquid shares, right? It tends to affect the valuation of the companies more as compared to locked in shares or ESOPs or restricted stock units or warrants, right? Because usually we tend to talk about the liquidity in the market, flows and liquidities, FII flows, domestic flows, liquidity. How much liquid is the market? How much buying and selling is there? How much is the demand? How much is the supply? Is supply more than demand? All these things we tend to talk about in terms of the flows and liquidity, right? Again, there's a separate debate upon liquidity and flows, right? Because the current market, if we talk about, people are talking about the liquidity and flows. What exactly is the difference between the liquidity and flows, right? Which is impacting the market as of now, right? So liquidity is basically being impacted, though they're, I would say, interdependent or interrelated or somewhat linked to each other, because ultimately all these things depend upon the freely tradable shares in the secondary market. Promoters have their shares intact. ESOPs and restricted stock units are there with those guys, employees or some founders and owners. Warrants might be there with some other people. But ultimately, the liquidity and the flows are affecting the valuation of a company. So pay more weightage to basic EPS. Don't try to restate that EPS to dilutive and try to make some different kinds of interpretations, right? If something which is not necessary, it is just good to know if someone asks you in the interview, right? Okay, what's the difference between a diluted EPS and a basic EPS? But it's fine. Take the normal EPS. No need to restate that EPS to a diluted one, ideally, right? Because market is being driven, apart from fundamentals, it's being driven by liquidity and flows. Current situation, liquidity is not so much, I would say, not so much lean. It's still tight. In the current scenario, the liquidity is still tight, though we have some 1.5 lakh crores of liquidity being infused by RBI, right? Recently in the news, around 60,000 crores via the VRR, right? Via the repurchase agreements, right? We have some FX swaps, right? For USD and INR, right? To the extent of some billions. All these things were infused to get more liquidity in the market, but still the liquidity is tight. The repo rate got reduced, agreed, from 6.5 to 6. Even the CRR also got reduced in the previous RBI MPC meetings from like 4.5 to 4, but still the liquidity is tight. The liquidity needs to be reduced. Into say the liquidity needs to be increased, right? It needs to be free. So the current market ideally is being driven much of flows. And what do I mean by flows? By flows, I mean the FIs and the DII flows. The FIs are selling in the market, the DIs are buying it. But still the market are falling. If, for example, around like um $2 billion of things, around $2 billion of FIIs outflows, right? Or around, if you talk about January or like February, right? Around like 70 to 80 billion dollars, 70,000 crores. Like we have seen the FIIs wiped off. They've sold off in the market, right? And the DIIs have purchased the same amount approximately. But still the market is falling. Right? Ideally, if the FIIs are selling off, the DIIs are buying it, the market should be either in a phase of consolidation, or the market should rise or stay intact. But who is driving the market? Because apart from the FIIs and DIIs, we also have an other component, right? That is of your family offices, HNIs, pension funds, right? Because all these people are something which we are not talking about. They're selling lakhs and lakhs and crores of money in the Indian markets, and that is also like one of the reasons why the Indian market is correcting. So liquidity and flows, it tends to affect the stock markets, the individual stocks, and ultimately the valuations, right? So it's a game which is being driven more by liquidity and flows and not completely by your earnings. Earnings are important, but as of this particular point of time, it's being driven more of liquidity and flows, right? Earnings is also one of the reasons being degraded, being coming down, right? But as of now, if we see the flow picture, it's more of the liquidity and the flows, right? So that is, we talked about the EPS. Okay. Ab, This EPS we take in the denominator of the price to earning. This EPS we take in the denominator for the price to earning. This EPS we have taken in the denominator for price to earning. Now, here we see the current market price of a share and we divide it by the EPS, the earnings per share. This current market price is the current market price as of today. So, for example, if you are calculating the price to earning of a company, you take the current market price as of that particular date. You do not take a historical current price. अगर आज calculate कर रहे हो, then आज share का price क्या है? So that you take in the numerator, and then you tend to divide it by the earnings per share. Now the thing is, the current market price in the numerator, it tends to fluctuate on daily basis because price changes every day on account of positive sentiment or negative sentiment. If there is a positive sentiment, the stock price might rise. If there is a negative sentiment, the stock price might fall. So it tends to fluctuate on daily basis. रोज price change होता है, right? There's one question somebody asked me, Devesh, higher EPS is high growth in future. See, higher EPS as of now, it doesn't always indicate higher growth in future because past performance might not always indicate a good future performance. Correct? So that is one thing. अगर EPS आज अच्छा है, it might not indicate it shall be good in future. But as per the financial modeling, forecast, calculating a forwarded EPS, right? It might give you that picture. And they're the work of the financial modeling and valuation, analyst estimations, management outlook, management commentary comes into place. Okay. So coming back, and this price to earning ratio that we're talking about now, we're talking about a historical price to earning ratio or a trailing price to earning ratio, maybe for the past 12 months. There's one trailing price to earning ratio, right? Like which we tend to see. That is past 12 months, trailing price to earning ratio. There is a forwarded price to earning ratio or a forecasted price to earning ratio that you calculate in terms of the financial modeling and valuation. So firstly, we're talking about a trailing one, right? So in this current market price, we can see is a leading indicator because stock market or the prices of the shares or the stocks in a stock market are the leaders. They're the leading indicators. They're being driven by sentiments. Every day the stock prices tend to change. They might change by even minute decimals, some 0.00005%, but they will change, right? But the EPS of a company will not change on daily basis. It might change, but the data is not published on daily basis. EPS you only get when the company declares the profit after tax because EPS is something which is driven from the profit. It's a proxy for profit. It's a proxy for the profit growth maybe, right? So the company tends to declare the profitability number either on an annual basis or quarterly basis. So you can only calculate EPS either on an annual basis or a quarterly basis. So assumingly, if you're taking it on a trailing 12-month price to earning, a trailing 12-month price to earning. So in this case, the current market price shall be the right now आज का price, which is a leading indicator. The current market price आज का, which is a leading indicator, and the EPS is somewhat like which shall be of past 1 year, right? It shall be a lagging indicator. Why lagging? Because it is historical and past performance doesn't always indicate future performance. अगर past में company का EPS is 100, 200 did very well, it might not indicate that it shall be good in the future. It might be good, I'm not denying, but it might fall also. Correct? So in this case, the numerator is a leading indicator and the denominator is a lagging indicator, right? So this price to earning ratio that we calculate, which is being used in the market every day, every time for all the companies, it might be a distorted figure. It might be a distorted figure, but no one really talks about this distortion because every analyst, every management is talking about we value this company on a price to earning. The trailing price to earning is this. The forward price to earning is this. We expect the company to trade at a forward price to earning multiple of 5x or 10x or 20x, right? Because everyone talks about the price to earning. It is too simple to calculate. It is too simple to talk about. It is too simple to justify because it talks about the earnings. And wherever earnings are there, people tend to get swayed away because everything has been driven by earnings always. Correct? But this ratio is not wrong. I'm not saying this price to earning multiple is completely incorrect, right? But there are improvement of this price to earning ratio. There are other ratios like which are improvements over this price to earning ratio, which can be used instead of the price to earning. And again, these are heavily used as well in the market. We'll talk about that ratio in the subsequent session because this session I'm completely trying to center towards the price to earning, right? But this is the distortion in the price to earning. And it is the conceptual understanding as well for the price to earning, right? So from a valuation perspective, if we talk about price to earning, see, it is basically telling you what price we are ready to pay for 1 rupee of the earning of a company or a $1 of an earning for a company or some other currency in that particular market. So if a company makes up EPS of 1 rupee, right, how much price we are willing to pay for that 1 rupee? For that $1 worth of earnings, how much price we are assigning to that company? So for example, if the EPS of the company is 20, it means for a 1 rupee earning, we are ready to, sorry, if the price to earning for a company is 20, it means for a 1 rupee or a $1 of EPS or earnings, we are ready to pay 20 rupees or $20 for that company. Now, we talk about the valuations, overvaluations, undervaluations, right? So this thing is, see, if the EPS of a company is too low, right, the basic interpretation. If the EPS of a company is too low and the current market price of a company is high, it means the earnings of the company are low, they're not solid, but the price is very high. In that case, we can say the company is overvalued because anyways the earnings should support the price. If earnings are not supporting the price and there is a divergence between the numerator and denominator, the company is undervalued. The earnings are too low, the earnings are not too strong, and the price is very high. There might be some positive sentiment, there might be some bull run, there might be some irrational exuberance. And what do I mean by some irrational exuberance? It means when everything is rising in the market, then people tend to purchase anything in the market, be it penny stock, बेकार company, and सब कुछ market में होता है, right? And the vice versa is also true. It might happen the earnings of the companies are too strong. The EPS might be very big number, a very good number, but the price at which the company is trading in the market is low. Ideally, the price of that company should be high because price is being governed by your EPS also. It's governed by sentiments also, but by EPS too. A company का EPS इतना strong है, so anyways the price should also be high. But in that case, the price is low and the earnings are super strong. In that case, the ratio might be low. It might be a smaller number. In that case, we can say the company is undervalued. The company deserves a higher price. By how much it is undervalued, by how much it is overvalued, it depends upon forecasting techniques, the financial modeling and valuation, and that we have studied already, right? And this is the major basic interpretation of the price to earning. And we tend to see it basically on an average basis. Always compare your industry company with a similar company in the same industry. If you're calculating the price to earning for an IT company, Infosys, always compare Infosys with an IT company only, be it TCS, be it Wipro, be it Coforge. You cannot compare Infosys with Tata Steel. You cannot compare Infosys with Tata Motors. You cannot compare Infosys with Marico or Britannia or Nestle, right? So comparison should always be made within similar companies. So for example, if I'm calculating the price to earning of Infosys and hypothetically it comes out to be 60. Now the number might differ in the real world. I'm just taking an kind of an hypothetical examples, and these are no stock recommendations. The companies which I'm naming here are no stock recommendations, right? Do your own research to buy and sell the stock. Okay, it is just for educational purposes, for example purposes only. Assumingly 60 है. But the average price to earning ratio of the Nifty IT which comprises of all the IT companies is 40. तो पूरे इंडेक्स का 40 आ रहा है पी, right? But Infosys is trading at 60. It means Infosys is overvalued as compared to IT, right? Now, this is something where we're trying to compare Infosys with the sector average. The second way can be Infosys historically over the past 10 years has traded at a multiple of 80. Over the past 10 years, historically, it has been trading at a multiple of 80. So you every year ka you took into account a price to earning. मानो past 10 साल का you have 10 price to earning ratios. You took the average A plus B plus C plus D plus E plus F plus G plus H plus I by 10. Simple average लिया. It came out to be 80. But currently it's trading at 60. In that case, you can say the company is undervalued. So either you can compare your stock with the sector average or a historical stock price. के बेसिस पे, historical stock PE के basis पे. Because there might be some stocks in an index which might outperform the index, which might outperform the other stocks in the index, right? So it is important to compare as per the past averages of that particular stock. It's important to compare as per the index also, but much more important to compare as per the past P of that particular stock. Right now, the thing is, we always say, okay, in a theoretical way, right, that always buy an undervalued stock, always sell an overvalued stock, right? As per theory in books में लिखा होता है, तो कोई भी ratio, always buy an undervalued stock and always sell an overvalued stock. In real life, it might not work. If we talk about an undervalued stock, when will the stock be undervalued based upon price to earning? It will be undervalued when your earnings, right? It might be undervalued, right? When your earnings are more and price is less. But it might also be undervalued when the earnings are too low and the price is also very low. Some kind of penny stocks जो 10 rupees के मार्केट में बिक रहे हैं, 10 rupees, 20 rupees, 30 rupees, 5 rupees, penny stocks. People tend to pump and dump. एकदम से प्राइस बढ़ता है, देन गिर जाता है. Those are penny stocks, घटिया stocks, बेकार stocks. उन stocks को लोगे? Of course not. So it might not always be good to buy an undervalued stock. They might be fundamentally poor stocks or penny stocks, and vice versa is always true. It might not always be good to sell off an overvalued stock too. It might happen the price to earning multiple might be trading at a very high number, more than the sector averages, more than historical price to earning averages, but the earnings might be supporting that price. Quarter by quarter, the price is rising exponentially, but the earnings are also rising exponentially. But in that case, even the higher valuation is also justified, right? You might not like to sell off that stock, you might hold that stock, right? Or even buy more. So that scenarios might differ in the practical situations. And we tend to say, the earnings growth are justifying the price. It means the EPS ka growth is justifying the current market price. The EPS is strong. If the price is also rising, the EPS is also rising. If it's overvalued, well and good, हम और खरीदेंगे. क्यों? Because the earning growth is justified. The earning growth is justified. And that is where your price to earning multiples get re-rated. You might have heard about the re-rating of the price to earning multiples. The price to earning multiples get re-rated, and they tend to get re-rated on account of these earnings also. The expectation is the earning will be high, the EPS will be high. As per the financial modeling and valuation, the multiple gets re-rated. The EPS number will tend to change. या तो बढ़ जाएगा या फिर घट जाएगा, right? And the second thing is they tend to calculate, and this number की वो बढ़ जाएगा या घट जाएगा, it comes from the financial modeling and forecast. That forecasted EPS you tend to take in the denominator. And that is when you create a financial model. You calculate a futuristic profit, PAT करते हो forecast, right? And उसी PAT से you calculate a forecasted EPS. And उसी forecasted EPS से you tend to calculate a forecasted price to earning ratio. You take the current price. Again, in that case also you take the current price and you divide it by the forecasted EPS. And you get a forwarded price to earning multiple. And the re-rating is done upon all that forecasting, right? So it might not always be good to purchase an undervalued stock, and it might not always be good to sell off an overvalued stock. And that's the basic in-depth conceptual understanding of the price to earning ratio. If I just show you one thing is, see, price to earning निकालना है किसी कंपनी का, ठीक है? So if I just show you where it is, maybe I'll just share my entire screen with you now. You might find some haphazard things here and there. Ignore that. इसको ignore मारना. It's out of scope of this discussion. I was just thinking about Nestle. Okay, this is like this company we have been doing it anyways. I took out the latest annual report of Nestle. ठीक है. अब Nestle का ना, if you want to calculate EPS, right? Simply we know that how to calculate EPS now. ठीक है. हम profit after tax लेंगे, correct? The profit after tax कितना आ रहा है? It's coming as 39,328 crores. Simply ये एनुअल रिपोर्ट में नंबर दिया हुआ है. हाउ टू डाउनलोड द एनुअल रिपोर्ट आई हैव टोल्ड यू ऑलरेडी इन द इनिशियल सेशंस. ठीक है. 39 320. नाउ दे आर लाइक मल्टीपल सोर्सेज, BSC, NSE, मनी कंट्रोल, गूगल, राइट? कहीं से भी निकल जाएगा ना रिपोर्ट ये। 39 328, राइट? हाउ टू गेट द आउटस्टैंडिंग शेयर्स? मेनी पीपल टेंड टू कंप्लेन, यार हमें ये प्रॉफिट आफ्टर टैक्स तो मिल जाते हैं बट आउटस्टैंडिंग शेयर इज इन मिलियंस एंड बिलियंस। यार अगर ये नंबर करोड़ में है, आउटस्टैंडिंग शेयर्स मिलियन बिलियंस में है, दैट्स अ यूएसडी करेंसी, दैट्स नॉट a USD currency, but it's a terminology being used in US and Europe. You have to convert that to crores simply, right? आउटस्टैंडिंग शेयर्स कहाँ से मिलेंगे? सी, नोट्स टू अकाउंट से मिलेंगे। एंड हमें वो नोट नंबर कैसे पता चलेगा? हम बैलेंस शीट में गए, इक्विटी शेयर कैपिटल का जो नोट नंबर है, इसी के आसपास ही कहीं होंगे आउटस्टैंडिंग शेयर्स, करेक्ट? वी वेंट टू नोट्स टू अकाउंट अराउंड 16 17 के आसपास, दैट वी शुड गेट, और लाइक समवेयर अराउंड दैट, 16 17 यहाँ पे कितना आ रहा है? इक्विटी शेयर्स आउटस्टैंडिंग मिल गए, क्लियरली यहाँ पे लिखा हुआ है इक्विटी शेयर्स, फेस वैल्यू से हमको मतलब नहीं एज ऑफ नाउ, राइट? इक्विटी शेयर्स, करेक्ट? सो यहाँ पे सेज ऑथराइज कैपिटल में इतना है, इशूड सब्सक्राइब्ड एंड फुली पेड अप 964 something, reconciliation, shares outstanding at the end of the year, right? So if we take the shares outstanding at the end of the year, at the end of the year कितने shares outstanding है, right? And we take this number of 964, right? Simply हम ये नहीं लेंगे millions of shares, यहाँ पे ये लाइक, यहाँ पे लाइक यू हैव दिस कन्वर्टेड अमाउंट स्पेसिफिकली यहाँ पे दिया हुआ है, ठीक है, राइट हैंड साइड में। इससे इफ यू डिवाइड दैट 33 करोड़ का नंबर, that will go in decimals, 0.000333, that number is somewhat distorted, just take this 964, ठीक है? एंड वहां पे अपना नंबर क्या था? हम्म, 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 हम शायद, नहीं, सही जा रहे हैं, ऊपर ही जाना है, ठीक है? 39 328, ठीक है? 39 39 328 डिवाइडेड बाय 964, ठीक है? EPS comes out to be around 40 something, ठीक है? 0.79, it means for 1 rupee worth of earnings we are ready to pay 40 rupees or 41 rupees if you round off. I go to Google, if I go to money control पे I see the ratios for Nestle, right? EPS is around 40.79 only. मैच हो रहा है अपना नंबर, करेक्ट? अब we want to calculate the price to earning. Price to earning हमने my bad, we have just calculated the EPS as of now, right? So the interpretation like which I gave you of like 40.79 was wrong, my bad, ठीक है? EPS we calculated, or this number of EPS we have to take in the denominator now, and this current market price for Nestle India we have to take in the numerator. So 2197 divided by 40.79, करो calculate, 2197, the current market price as you can see as of the Friday का close, divided by 40.79 or 41. Give me the answer in the chat box. Anybody? 2197 divided by 40.79. And that will give you the price to earning. करो यार कैलकुलेट, सिंपल सी कैलकुलेशन है, ये भी मुझे करके देनी पड़ेगी। 2197 डिवाइडेड बाय 40.79, 53, 53 है, राइट? 53। एंड इफ यू सी ऑन गूगल, लाइक वेर एवर यू गो ऑन गूगल, the current price to earning ratio of Nestle is around 53 to 55. मैंने ऐसे रैंडमली, मैंने गूगल पे भी टाइप कर रहा था मैं, आई डोंट नो दैट इज देयर और नॉट, नेस्ले इंडिया प्राइस टू अर्निंग, एंड वो सब पुराने पुराने आ रहे होंगे। सी इट माइट चेंज बिकॉज वो री रेटिंग होती रहती है, माइट नॉट फाइंड एग्जैक्टली, बट अराउंड 50 to 60 के रेंज में वो ट्रेड करता है। सी एज ऑफ लाइक February 13 वो 62 की रेंज पे था, ठीक है? एंड करेक्ट, एंड इफ वी सी यार हमारा कितना है 50, इट इज फाइन, इतना डिफरेंस आएगा, राइट? सो दैट इज द वे वी टेंड टू कैलकुलेट फॉर एवरी कंपनी. एंड वन थिंग ऑल्सो वी नीड टू अंडरस्टैंड इज this is the basic EPS. And यहाँ पे if you see this basic EPS and diluted EPS has been same for Nestle. Basic and diluted same है. It means there might be no restricted stocks. Ideally, there might be no convertibles. There might be no warrants. Same ही रहे होंगे, right? And that is why your basic EPS and diluted EPS is same. Basic EPS and diluted EPS. I'll come to cash EPS. Hold on. ये देख के like question rise हो रहा होगा, right? So basic EPS and diluted EPS is same. So see, price to earning is basically, I would say, calculated for all the industries. We generally use the price to earning for every possible industry that we can have in the market. People tend to use it bluntly and plainly. But there are some industries in which when people are using the price to earning ratio, they're completely wrong. For some industries, you cannot never use price to earning, like banking, NBFC, insurance. They're not valued upon price to earning. If some analyst, some portfolio manager, some commentator is saying the banks are cheaper on price to earning, NBFCs are cheaper on price to earning, they're wrong. Banks are always valued upon price to book value. And why? That's a discussion of subsequent sessions, right? And we have talked about in the modules too, in the previous live lectures as well, but specifically, like when we'll try to discuss about price to book value, we'll talk like much more upon that. Now, the thing can be for heavy industrial companies. Price to earning can be used. You are not completely wrong. But a better metric is either price to book value or EV to EBITDA. For a heavy industry, price to earning यूज करो तो completely गलत नहीं होगे. You'll be partially wrong, right? But अगर banking के लिए यूज करोगे, like you are fully wrong for banking and the NBFCs. For heavy industrial companies, infrastructure, cement, real estate, try using price to book value or EV to EBITDA more as compared to price to earning. Because those companies are based upon book values of assets. They charge depreciation, intangibles. But जब हम उन ratios की बात करेंगे, price to book value and EV to EBITDA, we'll talk about much more in that way, right? So you should know about the industries, when to use, when not to use, advantages and disadvantages. We tried to discuss about the price to earning ratio, right? Now, cash EPS. Anybody knows what's a cash EPS? See, if we talk about the cash EPS of a company, simple है, कुछ भी नहीं है, right? You simply take into account for a cash EPS. So generally people, they don't talk about it much more, but it should be talked. You take the cash flow from the operations, CFO, directly from cash flow statement, copy paste number, and divide by the outstanding shares. And divide by the outstanding shares. Cash flow from the operations and divided by the outstanding shares. So यहाँ पे if you go to the annual report, you see the cash flow from the operations. How much is the cash flow from the operations? Cash generated from the operations is 54,735. You simply divide it by the outstanding shares. It is telling you how much cash the company is generating on the basis of the outstanding shares. ठीक है? So cash EPS will take into account the cash flow from the operations and dividing by the EPS per se. My bad, अरे यार मैंने फॉर्मूला से गलत लिख दिया वहां पे. Sorry, right? And again, this cash EPS, again, it is see, not majorly people are talking about this. ठीक है? Majorly they tend to talk about your basic EPS or your, not even they talk about diluted one, right? They basically talk about basic EPS, right? But cash EPS is something that you can try to talk about. See, some people tend to use your CFO by EPS, even in big multinationals. Even I am personally like not using the CFO by EPS, right? But I believe it should be, right? Some people tend to use CFO by EPS. Some people tend to use it as CFO by the outstanding shares. So जो मैंने पहले फॉर्मूला लिखा था वो ठीक था, ठीक है? Because this is something which comes into account. CFO by EPS, it's a separate ratio. right? It can be called as cash EPS. It can be called as a cash conversion, profitability ratio, CFO by PAT or CFO by EBITDA. We'll talk about these things later. But ideally, from a theoretical perspective, the formula says your cash flow from the operations and divided by the outstanding shares. तो यहाँ पे अगर मैं जाता हूँ, ठीक है, तो यहाँ पे कितना है कैश फ्लो फ्रॉम दी ऑपरेशंस? 54,735, ठीक है, तो वही है। तो सी, नाउ नंबर माइट नॉट ऑलवेज मैच मनी कंट्रोल का नंबर, राइट? ओके, अपना आंसर माइट कम आउट अराउंड 55, 56, यहाँ पे आ रहा है 46, 10 का डिफरेंस है, राइट? बिकॉज समटाइम व्हाट हैपेंस इज मनी कंट्रोल नंबर्स टेंड टू गेट अपडेटेड, right? They tend to adjust those kinds of fluctuations or some kind of extraordinary or exceptional items which take place after the company publishes the results. So इसके बाद they tend to make some distortion here, right? But not to worry for that. It's a CFO by the outstanding shares. ठीक है? उसके basis पे simply you can just take the numbers from the annual reports and calculate it. ठीक है? So that is one thing. So this was completely about the price to earning ratio. Completely about the price to earning. In next session, we'll talk about other ratios. I'll be giving very small sessions on talking about like one ratio in general to keep you understand the very crux of it. But any questions, anybody? Or the price to earning ratio? Any questions, anybody? Any questions on price to earning ratio? Okay, if not, so this is about basically your price to earning ratio. Okay. Subsequent session, let's come up with more understanding about PEG, about the price to book value, EV to EBITDA, and different things. Right? So this is the price to earning ratio. Let's meet in the other session for more subsequent ratios as well. Okay. Okay. Thank you so much all. See you in the subsequent sessions. Thank you.